Why do some provinces impose additional rental obligations on non-residents? When non-residents invest in Canadian real estate, they often assume their only responsibility is paying the 25% CRA withholding tax on rental income. But depending on the province, that's only part of the story. Several provinces have introduced extra rules, taxes, and reporting requirements for non-resident landlords. These are designed to manage foreign ownership, protect housing supply, and ensure fair taxation. Here's what you need to know about these provincial obligations and how to stay compliant no matter where your property is located. The federal versus provincial divide. Canada's federal tax law, managed by the CRA, applies uniformly across the country, but provinces have the right to create their own property-related taxes and regulations. So, while your rental income is taxed federally under Section 2 and 16, your province may add extra fees, foreign ownership restrictions, or local property taxes on top. Ontario Non-Resident Speculation Tax, NRST. Ontario was one of the first provinces to introduce an additional property tax for non-residents. The non-resident speculation tax, NRST, applies when foreign individuals or corporations buy residential property in designated regions. As of 2024, this tax is 25% of the property's purchase price. While it doesn't directly apply to rental income, it significantly affects your initial investment cost, and failing to pay it can cause problems when selling or refinancing. British Columbia, foreign buyer tax and vacancy tax. British Columbia has some of the strictest rules for non-residents. Foreign buyer tax, a 20% tax on property purchases by non-residents in many regions, including Vancouver and Victoria. Speculation and vacancy tax, an annual tax ranging from 0.5% to 2% on properties that sit vacant or are used less than 6 months per year. If your rental property is occasionally empty, you could owe this tax, even if you're paying CRA rental taxes correctly. Quebec, distinct tax filing rules. Non-residents who earn rental income from property in Quebec must also file with Revenu Quebec, the province's own tax authority, in addition to the CRA. That means 2 separate filings, one federal, one provincial, each with its own deadlines and paperwork. Ignoring Quebec's filing obligations can result in duplicate penalties and delayed refunds. Other provinces with local requirements. Nova Scotia imposes an additional property tax for non-resident owners of residential real estate. Prince Edward Island limits how much land non-residents can own and requires permission for large purchases. Alberta and Manitoba currently have no additional foreign ownership taxes, but still enforce standard CRA rules. Each province updates its laws regularly, especially as housing affordability continues to be a political issue. Why these rules exist? These provincial measures aren't meant to punish investors. They're designed to stabilize housing markets and ensure local residents aren't priced out. However, for non-resident landlords, it means more paperwork and sometimes higher costs. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.